Good afternoon, it's Jeffrey Christian. It's Tuesday, the 16th of November, about 2:45. We have our winter light here in New York now. Wanted to bring up a general update of the economy, where we are, where we think we are, where we think we're going, and then also talk about the markets, updating them a little bit and where we think that they're going over the next few months. And I hope to talk about gold, silver, platinum, and palladium at this point. In terms of the economy, there are a whole bunch of issues, and I'll run through some charts in a second. There are demand trends. Demand has actually been very strong in the United States as well as in several other countries. We're seeing very strong demand, and that's actually being reflected in inflation. I'll show you some data on overall GDP activity as well as our projections. And one of the things that we're seeing is that it's not just a recovery in U.S. economy and in demand from consumer government. It's also a much bigger expansion. And I mentioned this before. If you look at imports, imports are up sharply from 2019 levels. If you look at interstate transportation, it's up sharply. If you look at consumption of any number of goods and services, they're up sharply too. And that actually has been flavoring inflation. The high inflation figures that we saw in October, which I think I mentioned a week or two ago, probably last week, partly was due to a stronger demand for goods and services pretty much across the economy. There's a stored up money. There's all that fiscal stimulus money that was paid out in 2020 and early 2021, which has been stacked up by some people, which is now being spent. And there's deferred consumption from 2020 and earlier 2021. So the demand has been very strong, which has been reflected in inflation. And you also have had a much slower response on the supply side. There are supply constraints, including labor, and there's supply distribution, or what people are calling supply chain constraints. Lack of truck drivers, lack of trucks, lack of port space, slowdown in the ports operations by the unions in LBC and Los Angeles. Talk a little bit about interest rates. Equity markets, I didn't put a chart in, but obviously they're doing pretty well right now. The dollar I'll take a look at, and then I want to run through some employment figures just to go, and then we'll talk about the precious metals. These are a list of issues that we pay attention to while looking at the economic and political environment that flavors investment demand for gold and silver, as well as industrial demand for all metals, including platinum and palladium, and to some extent investment demand or industrial demand for gold and silver. We've made the point in several presentations lately to clients and elsewhere, and probably in these videos, that as we look at these things, interest rates are not particularly negative for precious metals. They're actually positive for gold and silver. Equity markets continue to be very strong. The dollar continues to be pretty strong. Those things are somewhat distractive of investment demand away from it. And one of the points I made is that political issues are much more prominent in our view as being likely to lead to investment demand for gold and silver at this point. Both domestic issues in the United States, obviously, but also in various parts of Europe and other parts of the world. You have a lot of domestic political problems that are causing investors to say, I think I want some more of my money in safe haven gold and silver. And then also on an international basis, and that's obviously very strong there. So let's look at some charts. Real GDP in the United States, we are in an expansion phase, by which economists mean that the actual level of gross domestic product, the outputs of goods and services in the United States, are higher today than they were in the fourth quarter of 2019 before the pandemic and the economic lockdown. You can see on the right-hand chart, which is the percentage change year to year, the sharp decline in early 2020 and the sharp recovery from those depressed 2020 levels in earlier this year. And it's come back down to somewhat in more recent quarters. And it will come down in terms of growth rates further as we go forward. CPM, both politicians and economists across the real economy, we're starting to see more and more people talk about the potential of another recession sooner rather than later. That's a point of view that CPM Group has had really since the last recession last year. We've been saying that, yes, we'll see a decent recovery in 2021, somewhat continued growth in 2022, but the potential for a recession perhaps as early as 2023, more likely in our view 2024, 2025, and perhaps a pretty significant recession at that. And you're starting to see people start to talk about that as a result of the fiscal deficits and the growing debt. Growing debt not only on a federal level, but in states, corporations, private individuals, not only in the United States, but really in a number of other countries. Now you can see back here in 1980s, 1990s, we had some short, shallow recessions. And in fact, they were some of the shortest and shallowest recessions on records. And after 1980, we got into this period of time where we were also having about 10 years between recessions. 1980, 81, 82, the double dip recession, 1980, 2000, 2001, and then the big one, the Great Recession in 2007, 2008, into 2009. We had a recovery. It was pretty anemic. It was kind of flat. It was a little bit below trend. We had the big recession then. And now we're into this recovery phase. This is 2021, these spikes higher. And our expectation is that we have a lot of built up problems and issues to be resolved in the global economy and the US economy, and possibly we'll see the next recession. So that's one of the factors driving our intermediate and longer. I showed you these charts a couple videos ago. These are US producer price index through October. Very sharp on a year-over-year basis, less sharp on a month-to-month basis, and back down into levels that were relatively decent. Here's a chart that Carlos Sanchez on our staff put together this week, which is very interesting. This is US consumer price index year over year. And the headline, the core inflation, which excludes the more volatile food and energies, is the orange line. And then you can see these channels here. And the point that we are making with this is that if you look at it, and this only goes back to 2019, but you can go back 2010 probably, and you'll see that core and headline inflation were running either side of 2%, which is basically where the Fed thinks it ought to be. And we had an economy that was recovering slowly but steadily from the Great Recession and the global financial crisis. The lockdown, first off, you can see that headline inflation fell much more sharply than core inflation in early 2020 when we locked down. And you can see that we went down into this period of about 1% as the average last year for headline inflation, and about 1.4, 1.5% for core inflation. That was a transitory reduction in the inflation rate and inflationary conditions, and it made sense because, quite frankly, everybody was locked down. They weren't buying things. Now we are in a situation where you've got about a 4% annual average for core inflation and about a 5% rate for headline inflation, including food and energy. And that is that transitory factor. A lot of people keep making nonsensical fun about the idea that this inflation would be, in fact, transitory. And if you look at the data, it actually is, or the vast majority of it is. There are inflationary pressures that are secular, that are going to stick around for a while. There are some major shifts in the way the US economy works that'll probably be inflationary for some period of time. But the inflation that we've been seeing, 4%, 5%, 6% on a headline basis on a month to month, a year over year on a monthly basis, a couple times this year, that a big part of that will disappear within 12 months. Yes, they're rising. They're over 1.6% for 10-year bonds, and they are still very low by historical standards. This only goes back to 1985, but you can take it all the way back into the 50s, and you can see that interest rates are very low, and nominal rate, real inflation-adjusted rates actually have moved down because inflation has risen further and faster on a monthly basis compared to the rise in interest rates. So interest rates are not particularly a headwind for precious metals. And the dollar, for all of the talk about its demise in the dark corners of the internet and the scaremongers, fearmongers, the dollar is actually doing pretty well. And that's because the dollar is a reciprocal. And of course, now people have picked up on that. So they're saying, well, yeah, but it's all fiat currencies. We don't even need to talk about it. Two charts on industrial production. The government came out with industrial production figures for October this morning, and they're pretty strong. You see that on a level of actual economic output, we're not as high as we were pre-recession, but we're starting to pick up. Now we have picked up from what we were doing during the lockdown. Down in early 2020, now we've had a big spike up in 2021, and we're coming back to a more normal level. Back to what I was saying is that the economy actually is showing a fair bit of strength despite what you might hear in corners of the world. We've charts in the past, and I want to bring them up and update them because you'll hear people say that the US doesn't make anything anymore. The left-hand chart here is manufactured output in the United States. That it rose sharply and steadily throughout the period up to the Great Recession, up to 2008, 2007. Came down and then it came back up. It didn't get back to its peak, but it's been very high. And if you think about it, if you take a step back from the month-to-month, year-to-year changes, output is still very high by historical basis. The thesis that America doesn't make anything anymore doesn't hold up to statistical scrutiny. The right-hand chart explains why people say it. That's manufacturing employment. And in manufacturing employment, you can see, believe it or not, those of you who, like me, lived through the 70s, those are pretty rough economic times by comparison to what we've seen since then. But manufacturing employment actually peaked in the 70s. And after some changes in US taxation policy and the rise of globalization and containerization of shipping and deregulation, we saw a tremendous amount of employment disappear. Now, some of it went overseas. People who used to make furniture in the mid-Atlantic states of the United States would weave T-shirts, underwear, and socks and shirts in the mid-Atlantic United States. Those jobs have gone overseas to some extent, and they've gone overseas to what they call related companies. So a US clothing manufacturer will not own a Chinese or a Bangladeshi or a Malaysian factory, but it will have a contractual relationship with a national that does own those. And so what we've seen is a displacement of some employment to overseas. But if you break it down and look at it, we've actually lost more manufacturing jobs to computers and automation and assembly in various manufacturings, including autos and other manufactured goods. We've lost more jobs to computers than we've lost to overseas jobs. And that is one of the big dichotomies that's led us to where we are politically today, which is that manufacturing output's actually up. People who own and then, but they're not using labor. In fact, they've reduced their labor very sharply over the last 40 years. And that leads to those political issues that I was talking about. Let's talk a little bit about precious metals markets. Gold prices, two charts, one from 2010 till today, and one from 2019 through today. And we put that longer term chart here to give you some perspective. Prices are at record levels. They're down from where they were in the first week of August 2020, but they're at record levels, except with the exception of that. Prices are very high. On the shorter term chart, you can sort of see where we are, that we did see the price rise up again into August of last year, came back down into the first quarter, second quarter of this year, rose back up in the second quarter, and then it's been sort of trending water. And really in the last few days, we've seen it break above that channel that's been in place September and October. So we've started to see the gold price show greater strength. And as I've said in previous weeks, we expect that to continue. If we're seeing about a 1.8% increase in annual average gold price this year compared to last year, we're looking at maybe a 3.5%, 4% increase in gold prices next year. Modest increase, not running away, but it's going to probably claw its way higher as people look at the fact that we're moving closer and closer to the next recession and the next election. And definitely the by-elections in the United States will have a negative effect on investor psychologies. If you look at silver, very similar process, although the price increase didn't really start in 2019, the second half, middle part of 2019, the way it did in gold. There was a little bit of a jump up, but the big increase came in the middle of last year. And since that time, you can see on the shorter term chart, we've been basically moving in a channel. We have gone down and tested the bottom of that channel, breaking below $25 in August and September. We've come back up, and there's a very small channel that we're now testing the upside on. And if you look at it, you can see that with a few trading days exceptions, we've basically been trading below $28 for the last 14 months, and we're probably going to continue to. Longer term, CPM Group does think that the price pushes above $28, but it may well be later in 2022 rather than earlier. We might see some seasonal quarter because there is seasonal strength in the first quarter in gold and silver prices. But we're not looking for a sharp increase. We have seen a sharp increase this year because we're living off of a higher base. And up until August of last year, silver prices were down here below $20. They broke above it only in the middle of 2020. So the annual average price of silver this year is much higher than it was in 2020 because prices above $20 were only present in the silver market after August of last year, but they've been above $25 for most of this year. We do think that the silver price will continue to trend sideways to slightly higher. We're now looking for another 30% increase in the annual average price of silver next year. But we do think that the silver market is setting itself up for higher prices at some future time Platinum has been interesting this year. You can see from the longer term chart, platinum is really trading for the most part between $800 and $1,000 for most of the period from late 2015 into the beginning of the year. That and made a run to $1,300 in early 2021. Back below $1,000 in the middle part of this year. It's now back above $1,000. You can see that better on the shorter term chart. Our expectation is that the platinum price moves somewhat higher this year or into 2022. We don't see it running away, but we do see a lot of positives in the platinum market on a long-term basis. And palladium, it's the opposite. We've seen record prices steadily since really about 2017, 18, 19, 20, and 2021, and then into the second quarter of 2021. And since that time, it's come down. We don't expect the price to decline as sharply as it has between the second quarter and now next year. But we do think that the palladium price is vulnerable to further weakness of some amount, not as much as we've seen over the last 4 months, but somewhat. I wanted to tell you what our holiday schedule is. We won't have a video a week from Friday because of the Thanksgiving weekend that we all take off at CPM Group. And then we will have our last video of the year on winter solstice. We have to go out and do our pagan rituals. So we'll do our last video on the 21st, and then we're going to take off the rest of the year in terms of having videos. We may be, but we won't be doing videos. We'll come back on January 4th. Hopefully we'll be rested and all. Next year, we have a pretty exciting year. We have our yearbooks, Gold Yearbook, Silver Yearbook, and Platinum Group Yearbook, which we released in the first half of the year. We probably are going to roll from the last week of March to the first week of August, because we're also organizing for the IPMI a Future of Gold Roundtable seminar, physical seminar in New York City in the first week of April. The Silver Yearbook will come out probably the first week of May, as I think it did this year. And then Platinum Group Metals will come out in late June. In addition to that, we're going to go back into having our silver reception at the Prospect and Developers Association of Canada physical conference in Toronto in the first week of March. They didn't have it this year, and in lieu of our traditional silver reception that we've had for about 14, 16 years there, we had an online seminar on silver, silver facts and fantasies, because there was a lot of fantasy in the silver market in early March of last year. Discussions with our sponsors. We will go back to having the physical reception at the PDAC, but we're also going to have a silver online seminar in early March. And then we're planning to have a Platinum Group Metals seminar in late January, talking about what's going on in PGMs, with a special focus on the use of Platinum Group Metals in auto catalysts related to our assumptions and our analysis, which does that we're going to be burning petroleum, and a lot of it, in automobiles well into this century. I mean, past 50, we still expect half the cars in the world to be using petroleum in engine. And that means that we're going to continue to need Platinum Group Metals to clean up that exhaust for a lot longer than a lot of other people seem to be thinking. So we'll talk about that at a Platinum Group Metals online seminar in mid-February, where we will talk about future energy supplies, future energy uses, where the energy is going to come from in 2030, 2040, 2050. what is the outlook for market penetration rates of electric vehicles. We'll talk about fuel cells. We'll talk about silver in autos. We'll talk about automotive propulsion technologies and what is coming down the pike and how fast it'll come down the pike and what it means for different metals. Andrew Zemek, who works on our high purity manganese work, as well as molybdenum and other specialty metals, will talk about the use of some of these specialty metals in lithium ion batteries. We probably will also have a special talk about a clean energy fund that we're talking about launching in the first quarter of the year, which will have some special aspects to it. So we're going to take a couple days, weeks off at the end of the year to build up energy for all of those things. Next Wednesday, or tomorrow rather, we're going to have our open forum for our clients. We've got quite a few people signed up. We've got quite a few questions that have been sent in by email already. And then, the forum will be open that people can ask other questions live as the forum goes on. We've limited the early one for an hour. I wouldn't be surprised if we run more than an hour tomorrow. You can read about it on the Investor Program on our website. You can watch a video about who we are and what we do. You can buy our yearbooks. That's who we are. That's what we do. Stay warm if you're in the Northern Hemisphere. Stay cool if you're in South Africa. It's well over 30 degrees centigrade in parts of South Africa right now. And take care of yourself. We'll talk to you on Friday.